Thank you so much for joining me here. My name is Ashley Murphy. I'm the founder and principal of Arete Wealth Strategists. I'm thrilled to be joined here today by Dylan Goldspring, an international tax accountant with his own firm, CDG Corporate. Today's presentation is on case studies in US Australian inheritance. Today's my first day back from vacation. I spent a lovely 10 days up in far north Queensland, in Port Douglas and in the Daintree Rainforest. Wonderful time. I would highly recommend that. So without further ado, this will be posted, as all presentations are, to our YouTube channel. You can go to the Arete Wealth Strategists YouTube channel and see last month's presentation. Today's presentation is actually the third in the series. So we've been building up to this to do these case studies. But you can go there and see what to know about inheriting Australian assets in the US. And please subscribe if these topics are of interest to you. Very important to note, we always like to state this, can never say it enough, today's presentation does not constitute personal financial tax or investment advice. If you're seeking that, then I would encourage you to go find your own personal financial advisor or tax accountant who can give you personalized advice. Of course, that's precisely what Dylan and I do for our clients. A little bit about me. So my interest in cross-border planning has really been there from birth. I'm a tri-citizen of UK, Australia, and the US. Grew up in Brisbane, really discovered financial planning. Honestly, it was about 2002. A couple things happened. I inherited some money, had the settlement of an accident, and then began shopping for financial advice, which led me to realize just how broken the model was. And so when I landed in the US and discovered that there was such a model as what's called a registered investment advisor, and that's someone that has a fiduciary obligation, a legal obligation to put their client's best interest first, the angels sung, the scales fell from my eyes, use whatever metaphor you want, but I knew that this was what I wanted to do. A professional with a fiduciary obligation sitting on the same side of the table as the client, where you essentially are paying for advice. So that's my background. I'm also the founder of the GFP Institute. We have over 300 financial advisor members, and we train advisors on how to work with clients whose financial lives cross borders. Dylan, why don't you tell us a little bit about yourself?
So I'm an Australian citizen, born and raised on the Gold Coast. Please don't hold that against me. We have a bit of a bit of notoriety. I went to Griffith University on the Gold Coast, finished a Bachelor of Commerce. I've also done a graduate diploma in immigration law, a Masters of International Law, and previously worked as a CFO at a manufacturing company with a bit of international exposure. That really launched my personal interest in cross-border transactions. And I followed that up with a chartered accountancy membership, a fellow of the Tax Institute, and founded my own public practice firm in 2017.
All right, fantastic. Thanks for that. Just some examples of the kinds of issues that we work with our clients. I've got the first example here is an Australian business owner living in the US and some of the issues that they looked at and what we're able to obtain for them. A high net worth family currently living in the US, don't own a business, but were concerned about moving away and what their implication would have been from the US exit tax. And lastly, an Australian executive and their family having permanently relocated to the US and what that looked like in terms of bringing their whole estate over and making sense of their Australian financial life in the US and adapting it to that environment. So today's presentation, what we're doing is we're looking at two case studies from two different sides. So what about US property received by an Australian beneficiary and Australian property received by a US beneficiary? And so here's the outline of what we'll be covering. So what does the US Australian estate tax treaty mean in practice for an Australian inheriting US property? Just going to boil it down as simply as I can. I'll provide an overview of what was covered in a previous presentation of how US property is received for an Australian-based beneficiary. Then I'll do the case study of an Australian resident inheriting various US assets from a US individual. And then a case study double of an Australian resident inheriting various US assets. Okay. And then we'd really encourage you to write in with your questions as we present. We can make it a little bit more interactive, add some value to you as you listen to today's presentation. So please feel free to just chat in with the chat panel or the Q&A, and we'll answer those questions. So this is really a single slide answer that we have here, but there's some nuance provided, and I apologize for how text heavy this is about to be. And really what we have here is this. So a US tax resident, which I prefer that term because it's more than just citizens. It's permanent residents, or it's a non-resident, it's a temporary visa holder in the US, if assuming they had domicile, and even if they didn't, in fact, they'd still be considered US tax residents, is subject to estate and gift taxes on their worldwide assets. And an Australian tax resident, by contrast, is subject to Australian tax treatment. Now, I don't say Australian tax, estate tax, because there is no Australian estate tax, but we spent the first webinar in this series defining how that Australian tax resident with their Australian property would be treated. So we're just making a differentiation here where an estate tax exists and the Australian tax treatment for a deceased estate would apply elsewhere. Without an estate tax treaty, a non-US person, that is an Australian, just a regular old Australian, who has US Situs property, meaning assets that are considered to be located in the US, would only have an estate tax exemption of $60,000. That's the key. Without that estate tax treaty. Now, we do have this estate tax treaty, so what does that mean? What that means, well, is the final bullet point, but before we get there, if you are a US tax resident, a US person is eligible for a lifetime US gift and estate tax exemption of $12.06 million. However, that is scheduled to decrease to about 6.2. Why do we say 6.2? Because it was changed as a result of the Tax Cuts and Jobs Act in 2018, and it was 5 million at that time. So throwing some years of tax adjustments onto that, we get to approximately 6.2. That's what it's apparently scheduled to go back to in 2025. Now, is that a sure thing? Is that absolutely going to happen? No, it's not, because there's a lot of lobbying that goes on around that estate tax, and we'll see what eventuates there. But the critical effect for Australians who have US Situs assets is that they are grandfathered this estate tax exemption. So let's say you are an Australian who has inherited a US property worth $2 million, then you probably won't have any problems in the future with the US estate tax, because you've been grandfathered in with that, what is currently $12.06 million, and is scheduled to decrease to 6.2. A $2 million property is obviously less than 6.2. No estate tax issues to worry about there. So that right there is the benefit of the treaty, is that for US Situs assets, the Aussies get the US gift and estate tax exemption. Okay, any questions on that? That's pretty straightforward. I think the chief point of confusion here on this final bullet point is really to do with, hold on a minute, do Australians suddenly get caught in the US tax net? No, they don't. If you don't have any US tie at all, the only thing that would be caught would be those US Situs assets. And I'll define what they are in just a second. Okay, Alison writes in, is that also accurate for US citizens who are now residents of Australia? Alison, this is precisely why we did this webinar, is because there's so much confusion about this. And the answer is absolutely yes. If you are going back a slide here, a US tax resident, you're a citizen. If you are a US citizen, you are therefore a US tax resident, no matter if you move to Antarctica or Zimbabwe or anywhere in between. So you will be affected by that. And my case study, I hope, will demystify that point very slightly. Jesse, hey Jesse, how you doing? Good to see you. Does that apply even if the non-US tax resident files jointly with the IRS as a spouse of a US citizen? That's a fine question. And I'm looking forward to a certain conference call with the US CPA where we can answer that one, because that comes right in the middle. What Jesse's alluding to right here is there's a 4013G exemption, a once-in-a-lifetime exemption that applies for non-resident alien spouses to obtain US tax treatment. Not so clear on this how this treatment applies in that specific instance, but I may just take another moment to reread the question. Actually, files jointly with the US as a I'm inclined to say it would still apply, and it really wouldn't matter anyway if the amounts that we're talking about are under the estate tax exemption. So I think that's probably the safe, the belt and suspenders answers is even if the spouse does come under the US estate tax, provided your estate is less than the amount specified here, the 12 currently, hopefully we don't expect to pass away in the next few years. If it were to decrease to 6.2, that's very likely still less than the one's estate is likely still less than that 6.2, and if it's not, then there are other lifetime gifting strategies that can be employed to reduce that US taxable estate amount. I hope that was helpful. Okay. All right, just moving on there. So thank you for the question. Overview of how US property is received by an Australian-based beneficiary. Well, let's get into this. So you've already heard me define this term situs of an asset. Well, what on earth does that mean? It's not really that important to an American tax resident, meaning a citizen or a permanent resident, and it's not that relevant. And this is funny, doing this presentation, I actually had to revisit certain concepts that always come up when talking about international estate planning, and that's domicile and situs of an asset. But for a US person, for a US tax resident, those concepts really don't matter that much. And they don't matter that much because even if you're an Australian domiciliary and you're a US Australian dual citizen, your worldwide estate is still taxable. So it doesn't matter. So the domicile doesn't come into it. And the situs of the asset also doesn't matter. If you had your Australian superannuation and you're a dual citizen, the US is still going to consider it's still going to consider the Aussie super as part of your estate. So what does it matter? It will matter where the beneficiary is located, and we're getting to that. Okay, so the situs of an asset. Where is the asset located? Why does it matter? Because it's going to determine the taxing authority and how that asset is distributed. Physical property is really the most relevant, I think, and also assets held in trust would be another one. But that very quickly goes down a rabbit hole that's beyond my level of expertise. And that's where we get the international CPAs like Dylan and the international estate attorneys involved, because when you have a trust, it adds another layer of complexity because the trust has property. Where's the trust located? Where's the assets of the trust also located? And that's where I draw the line and say I just can't even opine on that one. But less easily determined items, but I'm going to specify them momentarily, would be intangibles such as intellectual property would be one example, stocks, life insurance, and then if the asset is US situs, is there a state estate or inheritance tax involved there? And I have a map of that coming up as well. So what is a US, or what are US situs assets? This is from the previous presentation here. Stock of US company, real estate, those are the main items that we'd see here, and qualified retirement plans. What's not US situs, which is this has no relationship to rationality or logic at all. This is just is what it is. So US listed American Depository Receipts is what ADR stands for. So this would be the stock of a company that has a presence in the US, but the primary listing is on a foreign exchange. So they're able to offer themselves to the US by virtue of what are called ADRs, but really they're foreign companies. Cash and demand deposits held in checking or savings accounts. So that's basically cash. Don't hold it in an investment account, or look what happens. It moves over to you being US Situs. Stock of foreign companies, of course, is also not US Situs. Publicly traded bonds makes no sense to me, again, that somehow a publicly traded bond is not US Situs, but a publicly traded stock of the same company could be different. There could be a different Situs for it. Importantly, the death benefit of a US life insurance policy is not US Situs, so that comes out tax-free. And offshore mutual funds, which we would never recommend anyway, but they're not considered US Situs, even if they're held by a US custodian. And that's a whole nother rabbit hole for another time. As I said, I'd never recommend it anyway. So what are states in the US that have their own state and estate tax? Well, we're looking at it right here. We see my home state of Minnesota. They're going to hit me, or not, well, me, maybe someday, hopefully not in Minnesota, but my parents-in-law, they will be paying somewhere between 13 and 16% to the state of Minnesota. Inheritance taxes, as you can see here in Iowa, where my marketing associate Jack is based, he's looking at a 0 to 15% inheritance tax. So that's different depending on the estate, meaning the total net worth of the deceased person, or in the case of Jack down here in Iowa, he's looking at if between he and his siblings, they're going to pay an inheritance tax depending on the amount that they inherit. So it's a tax one way or the other. How much you pay and who pays it exactly is what varies here. Or if you live in Maryland, then heavens forbid, you're looking at both. So let's see the type of the asset. This is really a summary of what we covered in the previous presentation. And that is, you're looking at retirement accounts. Now, the treatment is going to vary by whether you're a US tax resident or a non-US tax resident. Now, the US tax resident is pretty straightforward. Not a whole lot of doubt about this one at all. You're going to be subject to the 10-year distribution rule that exists now. There's talk about reducing that to 5 years, but currently you've got to distribute that over a period of 10 years, and you pay ordinary income taxes in the US on that account balance. You would then file a US tax return to determine how much was left owing, and then receive a refund if any was due to you. Now that you're an Australian tax resident as well, you would also have to see if you owed anything additional to the ATO. I'm sorry, can everyone see my screen? I just received a message that said that participants can now see your screen, which makes me fearful that you weren't able to see my screen. Maybe people can put their hand up with their Zoom, their Zoom control panel, just to indicate that they can. But I thank you. I just have a fear that someday that I'm talking that happens. So thank you very much. Okay, now the situation is a little bit different, and this is tricky here for the non-US tax resident inheriting a US retirement account. And that is, the US custodian will likely withhold to a non-resident alien, that's NRA, not National Rifle Association, non-resident alien beneficiary, they're very likely to withhold. And this has become worse in recent times with Schwab in particular. And that is even for let's say Australians that move back to Australia that have a US retirement account, they can take a tax treaty position and reference Article 18.1 of the treaty and say, these funds were procured by employment for retirement. That should be cut and dried. It's not always cut and dried, but it should be cut and dried. You should, even if Schwab or Fidelity withholds on that, you should still be able to get your money back by submitting your tax return, making that reference, having your W-8BEN on file, and getting that money back. However, the situation is slightly different in this situation, because the tax treaty, as you just heard me say, references funds that were procured from employment for retirement. A beneficiary of a retirement account did not procure those funds by employment, their own employment, for retirement. It's inheritance. It's a different thing. So this is where I'm going to have to pass you off to Dylan or to a US a US tax attorney for an opinion on this one. because and of course the amounts involved are going to depend on how serious you're going to get with those professional fees, of course. But our view is that the ATO, or at least on the Australian side, the ATO will say that the only Australian tax you'll owe there will be whatever growth has been attained on that account over its basis, and you'll likely get a foreign tax credit for anything that you owe to the US anyway. But it's this first part here about refunding any withheld tax that we're unsure about, and that's another one that would do well to obtain a tax attorney opinion on. Roth IRA is very similar. The only difference here is that for the US tax resident, there's not going to be any US tax withholding. Australia doesn't differentiate. They view both account types as being essentially foreign trusts, which is why we don't recommend Australian tax residents continue to fund a Roth IRA, or if someone's planning to leave, don't fund a Roth IRA, because Australia does not differentiate between a traditional IRA taxation and a Roth IRA taxation. So what would be the point of contributing to it with after-tax funds if you're then going to be taxed again when you get back to Australia? So that's the US tax treatment. The non-US tax residence treatment will be any growth in the account. It's really the same as above. Would the US custodian withhold? Very likely they would. They are on the side of caution. They have nothing to gain by using their brains and reading tax treaties. They just say, we're going to withhold no matter what. Liz writes in, hi Liz, thanks for joining us. How does Australia calculate the basis when the original owner acquired it, or date of inheritance? What a wonderful question.
I could jump into this actually.
Dylan, I was actually going to say, and what a privilege and blessing we are to have you on the call.
Perfect. So Australia tends to actually have a look back. So this is where it can actually get particularly nasty, where depending on the provision that we're actually referencing, Australia can actually disregard the fact that it was measured on the date of inheritance and look back to the original cost basis of the actual asset or the underlying trust asset. And that is actually specified in this particular ruling as well. I do recommend, of course, getting specific advice on the circumstance, but generally there is the potential for the ATO to look back. Okay,
very good. I'm glad you're here to provide that kind of opinion. Thank you, Dylan. All right, moving on. So US real estate. Well, this is a great example of a US Situs asset, right? I mean, even if you're in Australia, their real estate, if it's located in the US, is still very much located in the US. And so it's going to be sourced to state and country of physical presence. So if in my later example, we have a Colorado trust being sold, and that is going to be subject to Colorado state income taxes and US federal income taxes. And that really doesn't differ depending on the tax residence of the individual. So the non-US tax residents, it stays exactly the same. So you see that's precisely what's above. Investment accounts, brokerage accounts, the US individual gets a stepped up basis, so does the non-resident individual. Not much to be differentiated there. So that's good news. US life insurance, as we saw, it's non-US Situs. So one recommendation I often have for accumulation phase type clients who are in the US or leaving the US is get your life insurance in the US. It's cheaper, it comes out tax-free, it's in US dollars. And wouldn't we be singing that wonderful performance lately with where the US dollar is today, around 64.5, lowest it's been other than for single moments in about 15 years. Really, really quite a weak currency at the moment. Okay, so I'm going to move on now to talk about the case study of the Australian resident inheriting various US assets. So we've got James and Patricia. Albert Shearer is what we're going to call them. James and Patricia, you see US Australian dual citizen, and they live in Australia. Patricia is a couple of years older, Australian citizen, and of course Australian resident as well. Both are named as each other's primary beneficiaries, with their daughters as equal contingent beneficiaries. Okay, so here's what we're seeing in terms of the balance sheet. So really, this could be quite dry, but it's important that we just notice what's there. There are assets that are solely in James's name. There are assets that are solely in Patricia's name. And then there are joint assets that you see right there, thus arriving at the total estate value. Really no need to go much further into this at this point in time, because we're going to do that on the very next slide. So what happens when James passes away? We're going to assume James passes away before 2025, which means we have a $12 million lifetime exemption. After 2025, however, the amount above 6.2 million would be taxed at 45%. Now, the important thing to note here is that assets held in joint title are counted 100% in James's estate. And so we actually come up with an estate value for James here of 6.579. So in the future, that 379,000 over and above the 6.2 would be taxed at 45%. Now let's walk through each of these assets individually. Okay, so we've got a cash asset, which we know is not US Situs. We have an investment account, which is invested in US stocks. So that is going to be US Situs, but doesn't really matter anyway, considering the exemption. We've got superannuation, traditional IRA, and real estate as well. Okay, so the Situs, you can see I've crossed that out, really doesn't matter that much other than the Colorado property, which is a US Situs asset. So what do we see? The cash account, there's no tax due to anyone on that. The investment account, again, no tax due to anyone on that. Stepped up in basis by US. Conveniently, it's also stepped up by Australia. Dylan, any thoughts to add to anything I go through here? You're welcome to make a comment. Superannuation, sorry.
I just said thank you. I will if something pops up. Yeah. So
Patricia is a tax dependent of James, and so therefore the super account would pass without tax implications as well. As they're not in the US, that's also, and it's below the estate tax limit, that really doesn't come into it either. Traditional IRA, this is where it gets a little bit curly, is the role. So in Patricia's case, she's a non-resident alien as far as the US is concerned. We would open an inherited IRA for her and then seek to distribute that account to Australia. As mentioned earlier, the custodian will likely withhold on that, and there's not much we can do to prevent that. There's going to be some foreign tax credits that will be generated that can likely be used to offset the ATO's assessment. You heard Dylan say earlier, the ATO doesn't step up that account, unfortunately. So therefore, the original basis that James has in this traditional IRA will pass to Patricia. So she will have some Australian tax assessment. Whether she owes anything or not is going to be determined by how much tax was withheld by the US, and therefore how much of a foreign tax credit she can apply to reduce her Australian assessment. And the real estate, this is a curious one. Depends on what happens with the real estate. If the real estate is not sold, then there's really nothing to be done other than to file annual Colorado and US income tax returns. If it's sold, however, because this is US Situs property, then there's going to be Colorado Franchise Tax Board taxes owing, and there'll be US federal taxes owing. Okay, that I believe, yeah, that wraps up my Australian case study. Were there any questions about the Australian situation where we have the US resident, the US dual citizen dying and passing on their estate to their Australian spouse? No. Okay. Well, I'll hand it over at this time to Dylan Goldspring to look at the case study of an American resident inheriting various Australian assets.
Thank you. So in the next slide, we're going to meet our candidate for the day, and that is Brian. So Brian, the candidate, his mother has unfortunately recently passed away. Brian is a United States citizen and therefore also a tax resident. Brian's mother was a resident in Australia only with no US ties whatsoever. And when she passed, she left a considerable portfolio of cash and also certain assets to her only son. Now, importantly, Brian is 35 years of age and not currently a tax dependent. And Brian is seeking guidance on the tax implications of the inheritance as a whole. Now, the assets that Brian's acquiring are going to consist of a $5 million stock portfolio. Now, importantly, the basis in Australia of this portfolio was $2 million in 2015. And for reference, any numbers on the screen here are going to be in AUD. Understanding, of course, there would be a currency conversion on the US side, but to keep the concept simple, we'll just remain in AUD for the presentation. Brian will also receive $500,000 in cash proceeds from the sale of the Australian family home. He will also receive an income generating investment property, which was originally purchased for 200,000 AUD and has a current fair market value of $1 million. He'll also receive a distribution from his late mother's superannuation account. And importantly, as we covered in the previous webinar, superannuation accounts have a number of different components, the tax-free component and the taxable components. And then depending on the distribution, they may also incur tax withholding. So the first asset class that we'll run through is going to be the stock portfolio. Now, with the stock portfolio, recall that the Australian basis of the portfolio was 2 million AUD back in 2015. Importantly, when Brian receives the stock portfolio, he's going to receive a step up in basis on the US side, meaning that the US basis of that portfolio is now $5 million AUD, which is the fair market value on the date of the transfer or the receipt. Now, at this point in time, Brian has a bit of an election to make in the sense that he could maintain this share portfolio as taxable Australian property on the Australian side. If he does so, he will not have any capital gains tax to pay at the date of transfer. He will, however, essentially be looped into the Australian tax system for this share portfolio until those shares are subsequently sold. And this is where we see at point 2 there, if he does not make this election, then he is going to pay capital gains tax or tax at non-resident rates on the $3 million gain at the date of transfer. Now,
sorry, Dylan, I might have been a little bit behind you there. And that is significant, right, Dylan? So Brian is located in the US. He's got a $3 million gain. Non-resident rates, what does that mean for capital gains? That means no capital gains discount. And he's paying the whole, but pretty much not the entire thing, but almost the whole thing at 47%.
Correct, yeah. So in terms of that portfolio, if you stung with this particular tax, yeah, we're talking probably an average tax rate of at least 45% on that entire $3 million gain. On top of that, you also only have an asset and not necessarily the cash to pay that gain. So we're talking $1.3 to $1.4 million in taxes that are unfunded currently. So we're going to need relatively deep pockets to pay off the tax on that gain.
So this seems like a crazy planning scenario where Brian might be well advised to consider if he could perhaps work from Australia for a year, become an Australian tax resident, distribute the account, and save, from your back of the envelope calculations there, about $650,000 in taxes just by becoming an Australian tax resident if he wishes to repatriate those funds to the US.
Well, and this is the other competing interest here is that theoretically, if we recall from the prior webinars, these assets were originally pooled into a deceased estate trust and distributed out from there on the Australian side. If the deceased estate trust decided to sell the share portfolio and then transfer the cash to Brian, then we don't have anywhere near as much of a significant tax issue because the trust will be the one that pays the tax. So This is where estate planning, inheritance planning, vital in situations like this because it can be quite material.
So, sorry, Dylan, but please continue.
No worries. So let's say a year later, Brian looks to sell the share portfolio. The share portfolio is now $6 million, so he's done relatively well for the year. and he did nominate it to be taxable Australian property. So we've essentially deferred that taxable gain on the Australian side until this point in time, being the date of sale. Now, the Australian capital gain is going to be $4 million AUD. And again, this is going to be paid at non-resident rates with no CGT discount. So we're talking up around that 45+% mark. The US capital gain is going to be $1 million AUD. However, due to the foreign tax credits on the Australian side, the taxable or the tax to pay on the US side is going to be essentially completely mitigated because he's getting stung so badly with the Australian taxes on that total gain. So again, really reiterating, even if you were to not make the election and pay the taxes up front or pay the taxes a year later, you're still talking a very, very high tax rate overall. So not the best situation to find yourself in. Now, the proceeds from the family home. In previous webinars, we've talked about the main residence exemptions and certain other concessions for the family home. Now, in this case, we're talking about exactly what I suggested before with the stock portfolio, where the trust or the deceased estate trust is actually disposed of the family home prior to the distribution of cash. So even if there was any taxable components on the sale of the family home, those have currently been quarantined in the trust. The trust has paid any relevant taxes, if any even applied. And then the 500,000 is actually transferred to Brian as cash. And if transferred to Brian as cash, it's going to be non-taxable in the US. So again, a far more favorable situation than the previous slides. Now, the investment property, I would say, most closely relates to the stock portfolio in terms of calculation. The main difference here is that because the investment property is real property, being real estate, there is no option for it to be taxable Australian property. It will be taxable Australian property because it is real estate, and that's one of the more or less mandated views from the ATO. So with the investment property, the fair market value at the date of transfer is $1 million AUD. The original cost base is 200,000 AUD, and importantly, no exemptions were available. So Brian's late mother has never lived in the property. It has always been income producing. So in terms of the Australian side of the date of transfer, we have an $800,000 appreciation that's currently being untaxed. Now, the US basis is going to be $1 million AUD, which again is the fair market value on the date of transfer or the date of receipt from Brian. And again, because it is taxable Australian property, there's going to be no tax to pay at the date of transfer, but it is going to remain looped into the Australian tax system until the property is subsequently sold. Now, being an investment property, it is also going to be currently generating income and obviously incurring expenses. So there will be rental income and rental expenses and hopefully a rental profit to declare both in Australia and the US. And the US will allow for foreign tax credits for any Australian taxes paid on that rental profit. Now, if Brian was to sell the investment property 2 years later, the fair market value is now 1.5 million AUD. The capital gain in Australia is going to be 1.3 million AUD, again, taxed at non-resident rates, so particularly punitive. And the capital gain in the US being 500,000 will be relatively irrelevant in the scheme of things because the foreign tax credits generated from the Australian taxes will far outweigh any US taxes that could possibly apply purely because of that lack of step up in basis. So again, not a favorable situation. Stock portfolios or essentially income generating assets inherited by a foreign resident, not a favorable situation generally for anyone. Now, finally, I'm going to touch briefly on superannuation. I'll talk through the components, but there is quite a bit to this one, which is an area where you really do need specific advice on the circumstances. But to cover off, if a superannuation account is distributed on the death of Brian's mother, it's going to consist of two main components, and they're going to be the tax-free component and the taxable component. Now, the tax-free component, relatively self-explanatory. Australia will not tax that amount. However, the taxable component is going to be taxed, and that tax rate is going to depend on whether or not we're talking a tax dependent or a non-tax dependent. Now, as I mentioned at the start, Brian in this case is not a tax dependent, so he's not going to receive any concessions on that $50,000 taxable component. If the superannuation fund is distributing a taxable component to anyone, they are going to withhold tax on that to the tune of usually 15%, which is why we have an additional $15,000 tax withheld here. So out of this entire situation, Brian's received a 65,000 total distribution, being the tax-free plus taxable components. However, 15,000 of that has been withheld, so the net proceeds he's received is 50,000. Now, because this was an Australian distribution, Brian will need to actually complete an Australian tax return as a non-resident and declare the $50,000 worth of taxable component as income, where he will be subject to non-resident tax rates. Now, being 50,000 up to 120,000 is taxed at 32.5% for non-residents. So Brian's going to pay tax of 32.5% on that $50,000 component, which I believe is about 16,250, 16,500. So currently 15,000 has been withheld. Brian will need to top up essentially by paying to the ATO an additional 1,250 to them. Meaning the total tax that Brian's had to pay on this distribution was 16,250. Now, on the US side, we need to consider in a little bit more detail whether or not the superannuation fund was primarily funded privately by Brian's mother, or whether or not it was funded primarily from her work, i.e. she earned superannuation guarantee, the employer paid that amount into the fund, and that's what made up the majority of the fund balance. Depending on the situation, if we have a fund that's primarily funded by the individual, then we're potentially looking at a grantor trust in the US and tax to pay on the taxable component, because that will generally represent the growth within the fund, whereas the tax-free component will not. Whether it's classed as a non-exempt employee benefits trust is another example. And again, we're probably looking at US taxes on the 50,000 taxable component. In both cases, we should be entitled to 16,250 worth of potential foreign tax credits for the taxes paid in Australia. So the situation with super funds needs to be essentially looked at in a bespoke manner, needs to be considered on a case-by-case basis. But generally, this is the way the taxes are going to apply. That wraps up our situation with Brian.
Fantastic, and thank you for that, Dylan. I greatly appreciate that. So if you're interested in learning more or finding a time to talk, please come to our website and click here to get started. We've also got some resources that you can obtain there. And now would be a great time for us to swap over to Q&A mode. So if you have any questions, then we'd welcome them, and we'll do our best to answer them at this current time. All right. Yeah, that's a complex situation, the cross-border inheritance. There's just so many different ways that things can turn out. And then, you know, with Australia as well, I was going to interrupt you earlier, Dylan, and say, no wonder Australia could get rid of inheritance as estate taxes and keep a straight face, because having the concept of Australian taxable property means that Australia never loses out. I mean, they get to tax it at the rates that they want under any and all circumstances.
And that's effectively what we were saying in past webinars as well, is that although Australia does not have an exit tax necessarily, de facto they actually do, and it's surprisingly quite punitive. Right.
And then the other, I think the other low-hanging fruit observation for me from this series, Dylan, is where there is a possibility to have the Australian estate itself settle to cash whatever asset it has. If you have a foreign beneficiary, especially a US beneficiary, then you'd be well advised to do that, because the non-resident rates for capital gain assets in particular are just horrific. We did have a couple chats come through.
Yeah, hi, Gerald, I just read your message. Please try again if you don't mind. I haven't seen that email come through, but please flick me an email today, tomorrow, and I'll make sure to look out for it. And if not, I will get in touch.
Okay, very good. That seems to be about it in terms of oh, hold on, Alison has one. Is there any difference between de facto relationship and marriage certificates in either country for inheritance? Should one partner die? Wow, what a that's got me stumped. Okay. I would say
that's a very good question. So I think, look, on the Australian side, marriage and de facto are going to be treated the same in tax situation. So we have the concept of a spouse or a tax spouse, and de facto and marriage are both going to essentially be looked at the same on the Australian side.
Yeah, I'm inclined to say that the US has much less is much less strict and permissive with regards to identifying and recognizing de facto relationships. Like, they like to see people married. Alison, I haven't asked that question before, so I'm just coming up with my answer here off the cuff, but I'm inclined to agree with Dylan there. It's on the Australian side, you'd probably be fine because de facto is so tightly defined. Whereas on the US side, I think they would just say this is, one single individual with another unrelated single individual. That's just my guess there. Fantastic, everyone. All right, thank you so much for joining us, and we'll be back next month with an entirely different topic, moving on to something else. Don't recall what it is off the top of my head, but I hope you can join us next month. Thank you so much, and thank you, Dylan. Much appreciated.
Thank you, everyone. Enjoy your day.
All right, see ya. Bye-bye.